Well, this is in some ways the perfect follow to the wonderful comments from the BMA. We're going to be talking about private capital, the influx of private capital into the life insurance industry. I would just say at the Financial Times, I think we consider this one of the most important stories globally. I think it's a dramatic change in the private capital industry, and it's a dramatic change in the insurance industry. It certainly gives regulators a lot of new material to regulate and a lot of new new types of assets to oversee and much to keep up to date on. And so that's why I think it's going to be great that we have our panel here. So with us we have Andrew Sooboodoo, who is the Chief Risk Officer of InEvo Re, and we have Danish Iqbal, who's the Chief Executive of Somerset Reinsurance, and Anup Seth, who's the CEO of Agam Bermuda. And so where we're going to start is just to set the stage on what's happening in private capital and life insurance. And so I just want to go through our panel. What are the real changes we're seeing? How profound is this push by the private capital firms into the life market? So Andrew, why don't we start with you?
Great, thanks for the introduction. Very, very pleased to be here today to talk about life reinsurance. So I think it's hard to understate the importance of private capital within the insurance and reinsurance industry. And Bermuda's been a real core component of that. So just to level set with some facts and figures. So in 2022, the long-term reinsurance industry in Bermuda exceeded $1 trillion of AUM. We've had about $40 billion of capital contributed, private capital contributed. Between 2020 and 2022, about half of the life reinsurance claims paid out of Bermuda were funded by sponsor-backed reinsurers. And so that gives you a sense of how transformative private capital has been. And it's largely been driven by demand on the onshore insurance industries to provide capacity to them and to shore up their balance sheets.
Okay, great. And Danish, what's your perspective?
Thank you, everybody. Thank you for the opportunity to speak. Yeah, I'll just add to what Andrew was saying and sort of similar stats. The overall capital in the Bermuda market stands at about $135 billion. So there is the private credit market influx of that capital coming into the Bermuda market has allowed reinsurers to provide capacity to cedents, which then allows them to provide products to the people in the street and so create that capacity and sort of plug that retirement protection gap. So it's been really helpful, I believe, for sort of like the consumers on the street.
Okay. Anup, anything to add?
Yeah, thanks, Antoine, and good afternoon, everyone. Great to be here today. I agree with what Andrew and Danish just mentioned, and it's great to be following sort of Gerald's discussion around the retirement protection gap. And fundamentally, it's been an extremely positive for the industry, this influx of private capital. It's about making the industry more competitive. It's about bringing innovation. And it's about ultimately making the industry more resilient and giving back to the policyholder. How can we give more protection to the policyholders? How can we give them more choice? And how can we help narrow that protection gap? And I think the long-term sector has done plays an important role in that purpose.
Yeah. So, I mean, that's a great point, and I think there's both the innovation that's happening in the marketplace and then the need to kind of understand new risks that are emerging. So Andrew, I just wanted to get a sense on sort of how you're perceiving this influx of new capital, and are there new risk factors and pockets of risk that are being created by the private capital industry really pushing into the life sector?
Well, I think as a rule of thumb, if something's changing, then the risk profile is changing.
Yeah.
And so it's hard to, you're not often in a situation where risks are reducing, the risks are just changing from one type to another. So I think the risk profile of Bermuda reinsurance firms is changing over the last 10 years. I mean, there's a lot of discussion and rhetoric around private equity-backed reinsurers and the risks that private equity poses, but I don't think that's the most helpful way to characterize the risk. I mean, the IAIS, the International Association of Insurance Supervisors, which is the group of all global regulators, they prefer to look at an activities-based supervision rather than being overly concerned with the legal form of the owner or what products or services they offer more broadly. It's how are the shareholders and owners of these reinsurance firms, how are they behaving, and is it consistent in a way that supports long-term sustainable profitability and policyholder protection. So there are new risks, and I think they largely center around making sure there's appropriate transparency. The fee structures are transparent, that there is alignment between the shareholders, the policyholders, and all the other relevant stakeholders, and the asset allocations are appropriate for the nature of the liabilities.
Yeah, those are great points, and well, actually, let's dwell on them for a little bit, because I think, as the BMA just said, it is an area of focus. Danish, you're in many ways a perfect person to weigh in on this, because one could define Somerset in some ways as a private capital-backed insurer, but also, the sponsor is a holding company with a long-term time horizon. So maybe you can sort of follow up on some of the points that Andrew's making in terms of the governance structures and what are the ways in which this can be done well.
Yes, no, I appreciate that, Antoine. Just before we go on, like I appreciate the changing environment has created more risk or a different profile of risk, but there's a lot of sophistication that comes with that as well, and there's a lot of mitigants in place because for that, Bermuda has done a really good job, at least the regulator, in creating those protections. You could say, okay, 80% of the business that comes to Bermuda is fully collateralized. The investments that are being made are really high quality. 94% of the bonds are investment grade. Sort of like the private placements, 80% of them are investment grade, 90% of the CLOs are investment grade. So a lot of that is happening, sort of like the private capital sponsors have a lot of investment sophistication associated with them. And they can look at sort of like there's more, you could see more advent of people investing in AAA, AA CLO tranches that provide more spread than public IGs would and still not take enhanced risk for that. And that spread is then shared with the cedents and then passed back to ultimately to the policyholders. They are looking to invest in sort of real estate investments, which are ultimately longer duration, and sort of our liabilities are longer duration as well. So that provides better ALM. So sure, there's a changing risk profile, but a lot of sophistication that comes with it. Mm-hmm. And that actually, I think, is going to improve sort of like the overall resilience of the industry.
Right, yeah. Anup, you mentioned the sort of innovation that's happening. So are you seeing that mostly from the asset management side and effectively the assets that these private capital-backed firms are bringing into the insurance industry? I mean, there are some firms out there that have enormous origination capacity on their own. There's some firms who have decades-long investment track records, and so on and so forth. So just talk a little bit about the innovation, and then maybe weigh in a little bit on some of the governance issues that I think are paramount as these markets change.
Yeah, sure. And maybe before I do that, just touching upon a couple of points that both Andrew and Danish have made. On the capital side, Andrew's point I think is really important and worth reiterating. The capital that has come into this industry is permanent capital, and also it's high quality capital. So that alignment between the permanency of the capital and the long nature of our liabilities and policyholder benefits, we're here for the long term to meet those claims when they fall due is really important. And making sure there's consistency between that time horizon of permanent high quality capital and the liability duration is really important. On the investment side, yes, there are additional risks. But again, if we just step back and look at what is the approach the industry is taking here, these are fundamentally liability-driven asset strategies. Right? So we understand and we focus on the liability profile, and then we overlay an asset strategy onto that. So it's really important that is well understood. Then it's about, to Danish's point around investment grade. Yes, we have an element of illiquidity, and what we're doing fundamentally is we're looking at the illiquidity nature of these liabilities, and we're matching them with illiquid assets. And that's what we pick up, is that illiquidity premium on the asset side of the balance sheet rather than pure credit risk. So if you look at the credit profile of these balance sheets, to Danish's point, they are predominantly investment grade credit. So we're not playing the credit risk curve, we're playing that illiquidity nature. And we can do that because of the illiquid nature of our liabilities. Right? So really important that is well understood. And then, yes, when you then look at the overall asset profile, yes, there are elements of risk in there, new risks that are coming through, but you then have to mitigate those risks and manage those risks. And the way we do that is through ALM management. So we make sure that we understand the interest rate risks that our balance sheet has. How can we then manage that risk, right? So the modeling that is now available, we leverage technology to ensure that we understand those cash flows of liabilities and assets together. And that's why Bermuda is so important for these balance sheets. It's because it's an economic balance sheet regime. So you get rewarded for good ALM management. And that is one of the main attraction points for why this capital is coming to Bermuda. Mm-hmm. And on the innovation point, in addition to managing your own capital, these entities are now bringing in third-party capital. So sidecars were, not new to the P&C world, but they're relatively new for the life sector. And so we're bringing in not just PE capital, but we're bringing in, family offices, we're bringing in sovereign wealth funds, right. We're bringing in pension funds. So all of that capital is now coming into the industry in the form of sidecars, which again is helping to that ultimate purpose of helping to narrow that protection gap.
Right, it's creating an enormous new capacity, a lot of sophistication, and then as you mentioned with the sidecars, sovereign wealth funds, new entrants who are funding the insurance industry. Before we get to some other areas, I think that one thing I wanted to dwell on is there have been some negative examples, right, in recent years. You've had private equity-backed insurance companies in Europe, some in the US, fail, and it's raised questions about the model. And I think it allows us to talk a little bit about, more specifically, how to control governance. So what can we learn from the Eurovitas or the 777 partners, which is seems like a very negative story that's still unfolding. I'll just start with you, Andrew.
Yeah, I'll actually pick up on a couple of Anup's points first, and I'll come back, and just on the structure of the investments as well. I think another point of clarification that often gets missed is often these investments are on the PE firm's own balance sheet. They're not in a closed-end fund. That's really important. And on the illiquid nature of the assets. So our firm, we reinsure a lot of pensions liabilities. They go out 40, 50 years. And so, lending to a quasi-government organisation that wants to build a hospital that's got cash flows that go out 40, 50 years is entirely appropriate for the nature of those liabilities. So just to provide an example. On the failures, I think, again, maybe we've got some confirmation bias going here. So the number of insurance failures over the last 50 years is few and far between. We can think of some big ones, and they're not all private equity owned. Mm-hmm. This goes back to my original point about looking at the activities rather than the nature of the ownership. So when you look at the common themes of failures of insurance companies over the last 50 years, it tends to be to do with poor governance or poor modeling or that nature. There are a few examples where it's egregious, but they're extremely few far between and not on a big scale. If you really want to get into the big story, it's about governance. And so when we ask ourselves, how do all insurance and reinsurance companies protect themselves from failure, it goes to a lot of things that Gerald was saying in the previous discussion. It's about having a principles-based framework that relies on governance, having strong fitness and propriety tests. We've got the right people running these reinsurance companies, that the incentives are right, and there's appropriate oversight from the regulator to make sure policyholder protection is at the forefront of all decision making.
Yeah. One of the most clear sort of governance changes or ways of looking at governance is just the time horizon of the owner. So I think you sort of mentioned it, right? It's do you own this insurance company as a private equity investment, or do you own it sort of as a strategic investment where you're not just looking to maximize the return on equity for a very finite life and sort of get out and maybe someone else may pay a price in the future and so on. So Danish, if you want to just dwell on that governance question a little bit more, can you spell that out? Is that really the key issue that people are really have the sponsor has the same incentives as the actual insurance company and the insurance policyholder at the end of the day?
Sure. Yeah, no, I'll elaborate on the governance standpoint, and I think Andrew's right. I think that is the right way to mitigate this. And I'll also add that a lot of these things are actually happening as we speak, right? So the responsiveness from the BMA about sort of the 777 Re issue allowed the BMA to bring in a few different things in place, right? Like the PPP guidance, asset disclosures, conflict registers. So all those things are strengthening our governance, and we have a mandate on companies to have independent directors. The fees have to be based on arm's length economics. Right? We can go a little bit further and adjust sort of those fees based on maybe make them risk-adjusted returns rather than chasing raw yields, or maybe make them defer them for a multiple period based on solvency targets or have clawbacks. But things can be added and improved further. But the responsiveness from the regulators sort of from those issues have improved sort of our governance standards. Not that they were sort of one-off things, they weren't all like systematic risks, but those improvements have made the system very, very strong in my opinion. And I think there's a little bit more that we can continue to do and to continue to make that better. The other thing I would say is the sponsors, at least from our experience, they are in it for the long run. If they are going to come in and invest in these companies and and their economics are tied to our companies, they are there for the long run. They're bringing in permanent capital into the industry, and these liabilities are for a long duration, and they're there to continue supporting us and growing the business. I think they are finding a lot of value in investing in our companies, and they're seeing the returns there, so they will continue supporting the reinsurance industry, at least from our perspective.
Great. Anup, do you have anything to add on
Yeah,
that?
again, there's no substitute for strong governance or robust governance framework. And it really starts at the top of the organization, and the board has ultimate responsibility. Is there independent oversight that the board is providing? Is there sufficient challenge that the board is providing to management? And then you sort of go to the next level down, and you look at some of the key positions within the firm, right? And for our firms, the chief investment officer is a really important role. So do you have an independent CIO from the owner of the company? And that CIO is acting in the best interest of the company and the policyholders. Danish mentioned the prudent person principle, right? That comes in. But fundamentally, it's also about risk culture, right? What culture does the organization have when it comes to risk? And so making sure that you've got that robust governance framework is really important. And then the other thing I would add is, be aware of the 3 L's, liquidity, leverage, and market lunacy, right? Make sure you've got sufficient liquidity within your balance sheet. What's the leverage? And I'm talking about leverage of capital to invested assets or capital to reserves. And then the third is, the market can be, unpredictable. And make sure, and Gerald, referenced this in his slides, we might be fine on the base case, but what happens when you stress your balance sheet and look at those stress cases, and how do you perform under those stress scenarios as well is really important.
Yeah. Well, let's stick with the lunacy part for a second. I love you having given us a great natural transition. So one of the things we're writing about most at the FT is the changing conditions in credit markets, right? And so as we've just discussed, the influx of private capital to life insurance has brought an excess spread, and that's captured a little bit of the illiquidity premium. Unfortunately, right now, spreads are coming in, base rates are coming down. The last few years had been a very bountiful year for private credit, for credit investments, and those are starting to turn. So how do those changing conditions in credit markets now feed into the life insurance industry? And so, Andrew, if you wanted to start.
Yeah, we're seeing like historic tightening of credit spreads at the moment. It's really tight. I think they've winded a little bit in the last couple of weeks, but it's been really challenging environment. But I think this goes back to previous points about what the incentives are and how the business model works. So the products that are offered by the life reinsurers in Bermuda, there is an opportunity to reprice on a regular basis. Mm-hmm. And what we're one of the metrics that we're interested in is I think Anup mentioned it, the illiquidity premium. What's the comparative spread over publics? So if publics are at historic tights and so are privates, but there's still an additional spread and we're being appropriately compensated, then perhaps you can live with that. Or something that Danish and I were discussing just beforehand, if you do have the right governance structures in place, you just don't have to invest in private spreads. Mm-hmm. I think as a matter of prudence, we assume the secondaries market doesn't exist for private assets. So when you are buying a 40-year asset, you are keeping that asset for 40 years. And so maybe you make a decision to hold off investing in private spreads, recognize that you're not getting that investment return for the period where you are waiting, but wait for spreads to widen a little bit where you think the risk-adjusted returns are good enough. I mean, government-backed securities these days are looking pretty good on a risk-adjusted basis. And so, things are tight, but there are options to adjust investment strategies. And then the mechanisms that we have in place to make sure that we don't chase the spreads and go down the credit curve are quite clear. It's one, the cedent has always got an interest in the credit risk and the collateralized portfolios. So as Danish said, 80% is collateralized with the cedent, often onshore, and there are tight investment guidelines. Most entities on an entity basis will have investment guidelines, chief risk officer, independent CIO, as Anup mentioned. So there's a bunch of controls in place to make sure that when these situations emerge, we just don't go down into the sub-IG.
Got it. How are you reacting to these changing conditions?
Yes, so getting that illiquidity premium now is going to be harder, right? We are investing in teams and building our underwriting capabilities, going into slightly different strategies, more focus on sort of real assets, infrastructure assets, digital infrastructure assets, energy transition assets, and looking at better ways of managing collateral. And as Andrew was saying, as we were discussing, if we are sort of losing a little bit of spread, sure, you'll see sort of tightening of policyholder parameters, and we'll be passing on less spread back up. And sure, we don't have to continue chasing the same IRRs, right? This is a long-term business. We are here for a long period of time, and we can continue sort of building more robust capabilities, but we don't have to continue chasing the returns.
Yeah.
So the returns will go down a little bit,
Yeah.
but we are there for a long period of time to continue. And
Yeah. Is there any fear, Anup, that some of these new entrants have promised more yield that they're going to be able to deliver in the coming years, or maybe go down the credit curve to compensate for the change in the credit, returns?
I don't think so. And I would maybe draw the analogy, there's a lot of the people in the audience today are from the P&C industry, and we talk a lot about underwriting discipline on the P&C side. On the long term and the life and annuity side, it's all about investment discipline as well as underwriting discipline. And so, the chief underwriting officer earns their living in a soft market on the P&C side. The CIO earns their living in a sort of tight credit cycle, which we are at the moment, right? So credit spreads are at a 25-year tight at the moment. The challenge is to maintain that discipline. And if you're not getting those IRRs, or for the P&C sort of people in the room, if you're not getting your combined ratio, what do? Do you still underwrite, or do you stop, right? And that's the dynamic we're facing as well within the long-term sector. So I would just say, make sure that you maintain that underwriting and investment discipline is so important. Within that, though, there will be pockets of opportunity, as Danish touched upon a few, whether it's infrastructure assets, whether it's data centers, with the AI boom, whether it's the Magnificent Seven. They're all issuing new bonds now so that they can fund their data centers. And when you look at the yields there, they're not bad. So
Right.
There's opportunities there, but you've got to maintain that discipline.
Yeah. And just to stick with you, because you brought it up a little bit earlier, but one of the other pieces we hear a lot about in the industry is regulatory arbitrage. And a lot of the discourse now is about jurisdictions. So you sort of mentioned Bermuda as kind of being a favored jurisdiction where regulators have done a good job. There's a lot of discourse that some of the hot money is going into some of these other offshore areas. How big of an issue is that for us to focus on?
I would say that the market is very dynamic, and it's fundamentally about capital optimization, and also providing choices. So certain companies and the cedents and clients that you're dealing with want to have those choices, and they may desire a certain jurisdiction for certain reasons. So it's horses for courses. But what I will say about Bermuda is that the BMA has done a fantastic job of enhancing the regulatory framework, collaboration with industry before they've implemented that. I know there was some pushback, but when you fundamentally look at what has happened with the Bermuda regulatory framework, and it's easy to just quickly describe it in the 3 pillars. Under Pillar 1, the BMA has said, well, we want you to hold sufficient capital. We recognize the model that we have is not perfect, but here are some areas where we want to improve, and it's areas like policyholder behavior or lapse risk in our industry. It's an area that is tough to model, but they've recognized that that's an area that needed enhancement, and they've enhanced that. Around Pillar 2, it's all about governance, right? It's all, then again, as we mentioned earlier, there's no substitute for good governance. It's about enhancing that governance framework. And then Pillar 3 is all about transparency and disclosure. And we've had to enhance the disclosure that we're making. And I think those are all good things. It's all fundamentally good regulation. It's principle-based regulation. And it's an extremely credible regulator that we have, and we're privileged to be able to have the BMA as our regulator.
Yeah. Andrew, if you had anything to add there.
Yeah, I would like to echo all of Anup's points on the strength of the framework here. But we have seen a lot of private capital invested in Bermuda, but we've also seen it invested in other jurisdictions as well. So we had Brookfield by Just, we had Athora, Apollo by PIC, and Solvency UK is a really robust regulatory framework. So For those people that sort of suggest that private capital is interested in regulatory arbitrage, I'd point to examples like that. You've got Blackstone, Corebridge, in the US as well. So there are plenty of examples of private capital coming into a range of jurisdictions across the world, as well as Bermuda.
Okay, great. Well, we're at time, but I just wanted to thank everyone for this panel, and clearly it's an area of dramatic change, and where regulators here in Bermuda have spent an enormous time of focus. So thank you.
Thank you.